In this video, we're going to look at financial ratios. So how do we tell if the organization is effectively using its assets, its money, its debt, the money from investors? How can we tell if we're using that appropriately and effectively to fund operations? So we're going to go through a number of financial ratios. We'll look at net profit to owner's equity, net profit to net sales to fixed assets, net sales to owner's equity, current ratios, asset tests, receivables to working capital, inventory to working capital, collection period, and so on, you can see here. Now, in the next video, we're going to be looking at benchmarks. So when we're looking at is the company doing okay, we often need something to compare it to. So we can compare it to the previous year. So we can look at our financial ratios and say, are they improving? We can also look at our financial ratios and say, how do they compare to the rest of the industry? So we're going to be looking at, in this video, calculating these financial ratios for the industry. And then you have some assignments you're working through where you are going to do the calculations both for the industry and for specific companies like Amazon or a small business to see how it compares to those benchmarks. So right now we're pulling these benchmarks, the industry data from Industry Canada. And so you can see the link right there to the benchmarks. So let's take a look at these different financial ratios and what they tell us. So what we're going to do is we're going to calculate these financial ratios for the hotel industry, small and medium enterprise hotels. We're going to look at large industries like motor vehicles. So we're looking at companies like Ford. And you see the two empty columns there. We have the restaurants that are small and medium size enterprise. And then we have non-store retail large. And that's because if you are working along with us in the course, then you have some assignments where you are looking at a pop-up business, so farmers market selling cupcakes type business. So how does that compare to other food providers, so restaurants that are small and medium enterprise? And then as you look at Amazon, Amazon falls into the non-store retail large companies. And so you'll be filling in those two columns as you do the work for the course, and then comparing them. Those become the benchmarks as we look at the industry. You're going to compare them then to the individual companies to see how they compare. But for this video, we are practicing doing our financial ratios. And so we're actually going to calculate that column that you see that's the hotel industry, and we'll look at the different ratios and what they tell us. All right, so let's look at these ratios that we mentioned before. And so we need is the formulas for these different ratios, which is what you see here. So we'll spend a bit of time on this screen. And then let's look at each of these ratios. What do they tell us? What are we looking for in terms of a better performance? What kind of number or ratio are we looking for? Now, when it comes to these financial ratios, we can calculate all of these using the income statement and the balance sheet. So just to recap from our previous videos, here we have the income statement and how the different lines of the income statement. And then we have our different parts of the balance sheet. And so we're going to take the balance sheet and the income statement for the different industries and pull that information to do our financial ratios. So let's start here with net profit to owner's equity. And so when we look at net profit to owner's equity, we're looking at the return on investment for our investors. So people who have bought stocks in our organization, provided us funding, how much return are they getting on that investment? And so we're going to pull up a slide here where I can write on it. So what's better performance? Well, you'd like a greater return on your investment. And so we look at the net profit before taxes to the owner's equity, and we're looking for that return to be greater. And if we go and we look at, here, let's pull up our calculations here. Okay. We're looking for a net profit to owner's equity A higher number is better. And so to get this number, I'm just going to pull this over here. Got new Windows 11 here that's taken over my computer screen. Here we go. All right, so what we need, bring that back one more time. We're looking at net profit to owner's equity. And so we can see here for the hotel industry, our net profit here, and this is during 2021. So we're going to see the impacts of COVID in terms of the motor vehicle industry and the hotel industry. So we can see here in terms of net profit to owner's equity, that net profit here is negative 57. Oops, that's not even the right section. Let's try that again. Right there, negative 57.2. And we want to take that number and we want to divide it by our owner's equity, and that is this 8356.20. Okay. And it put in a little, I don't want that. Okay, there we go. All right, so we can see for the hotel industry, it's not good in 2021. They don't even have a positive profit. They're losing money. That net profit to owner's equity number is negative. What we see in terms of return on investment, that net profit to owner's equity, so if we're just making a running list here, is that we're really looking for a number that is greater than 15%. Now, that number is going to differ depending on the industry that you are in. And of course, you're going to take courses in finance and accounting that go into all of these ratios in a lot more detail. So just from a very basic view, we're just kind of trying to give you a measurement of what's a better number. So we want there to be a return on the investment. We want there to be a positive net profit. And of course, the more we can bring in for the amount that we invest, the better. And so we're looking for a number that's more than 15%. You can see here with our motor vehicles, you can see that they're sitting just above 16%. Okay. All right, so let's look at our next one. Our next one is net profit to net sales. And so we're looking at how profitable we are in terms of how much of that sales revenue that we generate do we get to keep as profit. And so if we're looking at what is a good number, it is considered to be high if you have a net profit to net sales of 20%, is considered to be low if you're sitting at about 5%, and an average is about 10%. Now, this is, of course, going to differ by industry again, so you have to look at the comparators for your industry. So if you're Amazon, for example, we need to compare it to other non-store retail. But so if we just generally look at the net profit to net sales, we're looking at net profit before taxes divided by net sales. So let's go here and look at our hotel. And all right, so we have our net profit again is that negative number. So that's going to be a problem for the hotel industry. And so we know, of course, right, during COVID, people aren't traveling. And so hotels are not making a whole lot of money. So we have that negative net profit. And then we're going to divide that by net sales. Now, when we're looking for net sales from this industry data, you can see that it says total revenue, and it's divided total revenue into sales of goods and services and then revenue from all other sources. And so consulting a colleague, a CPA accountant, what she told me is that assume the sale of goods and services is the net sales. That means it's net sales, it's including discounts and returns. And don't include the all other revenue because these may be sales, this may be revenue generated from the use of assets and not necessarily from the sale of goods. So we're just going to use the sale of the goods and services. So we're going to take that 806510. So divided by 806510. Okay. And so you can see here our net profit to net sales, we have a very low number and negative, right? Because of that, because they're not making a profit. If we make sure I type the right number in, 8065, and there we go, I'm missing the dot there, 806510. There we go. Now, if we compare this to the motor vehicles, you can see they're sitting at a positive. So they made profit in 2021 selling vehicles, and that the number is sitting at about 2.32%. And so we said that we're looking for one that is closer to 10%. If it's below 5, it's considered to be quite low. Remember, the motor vehicle industry had some challenges during COVID, could not get the computer chips necessary to operate the entertainment unit, to tell the car when to shift gears. And so those types of things meant that they couldn't produce and sell as many vehicles. And so that's impacting that profit there. All right, the next one we're looking at is net sales to fixed assets. And so here we're looking at how effective are we at using our assets, things like our equipment, to generate sales. And if we're looking at net sales to fixed assets, we're looking for a number that is greater than 2. Okay, so net sales divided by fixed assets. So here we can see with motor vehicles that the net sales to fixed assets here are 16. And so let's calculate it for the hotels. Now we need to figure out fixed assets. So when you're looking at the reports from Industry Canada, for example, you don't see anything that's titled fixed assets. Now when we talk about fixed assets, what we're talking about is we're talking about the equipment. I'll just go back to my slide here. Property, plant, and equipment. And so when we're looking at this Industry Canada data, we are looking at the one that's called net tangible and intangible assets. If you're looking at the balance sheet for a particular company, it might be listed as fixed assets. It might be listed as, and what we're seeing more and more is that it's called property, plant, and equipment. All right, so we want to find the net sales to fixed assets. We want to know how effective we are at using our assets to generate sales. So we are going to go to our hotel data. We want to find our net sales, which is going to be that 8065.10. And here we're going to divide by our fixed assets. That's our 21,057.70. Okay. So notice in the hotel industry that number is quite low. Now it's really going to come down to, right, the type of industry and how much fixed assets they have. So businesses that have greater infrastructure, more equipment, more buildings, they're naturally going to have a lower net sales to fixed assets anyway. So when we're giving a number to say, you know, this is good or this is bad, that's very broad across all industries. And so the reason that you would take your company, so your Best Western, how did you perform relative to the rest of the industry, the rest of the hotel industry, we would need to look at, okay, as a whole, the hotel industry had a net sales to fixed asset of 0.38. So what we see is that the assets are not generating a lot of sales. Of course, during COVID, people aren't staying in hotels, so it's really a sales issue here. Because we have all these fixed assets, we have all these hotel rooms, and it's just not generating us sales during COVID. So we need to compare our hotel, Best Western. How do we do compared to everybody else? Did we perform the same? Did we perform worse? And in this particular year, you can see that this hotel industry as a whole is having some challenges. All right, let's look at our next one here. So let's go into our ratios. We're looking at net sales to owner's equity. Net sales to owner's equity is not a common ratio, so we'll just kind of skip over it a little bit here, but you can see net sales to owner's equity. We take the net sales, we divide by the owner's equity. So we'll do the quick calculation here, but it's not a commonly used ratio, and so I won't go into details about numbers. But we can see it on this list that we get from this Entrepreneur's Guidebook. So net sales to owner's equity, net sales. Go back to our hotels. And we have our net sales, our 806, 5, and 10, and we're dividing that by equity 83, 56, 20. We have 6, 5, 10, and 83, 56, 20. Okay. All right, and we can see here how that compares to the motor vehicle industry. And so we have our investors who are buying stocks, putting money into the company, and then is that translating into sales? How well are we using investors' funds in order to generate revenue? And so you can see in terms of the hotel industry, because it wasn't generating a lot of revenue, that they're not generating a lot of sales for their owners. So if we're looking at this particular measure, think about it is I'm trying to get people to invest in my company, and there's going to be a return, right? So they need to know that their money they're putting into our company is going to make them something. So a higher net sales to owner's equity is more preferred, but where really our focus here, if you're an investor, is on that net profit to owner's equity. So are you making me money? Is there a return on my investment? Rather than just focusing on our sales or our revenue coming in. All right, let's look at our next ratio. And so our next ratio is a current ratio, and quite a popular one you often hear about when people mention financial ratios. And this looks at our ability to pay short-term debts. So how much liquidity do we have? Now, when we look at the current ratio, what we often hear is that we're looking for a number between 1.2 and 1.8. That's considered to be balanced. Sometimes you see a target for the current ratio at 2. Really, the idea here is that we are comparing our current assets, okay, so our inventory, our cash, how much we have of value, versus our debts, how much we owe. So if we have a current ratio that is more than 2, that means we have a lot of idle funds. We have a lot of excess cash. And if our current ratio is less than 1, then it means we can't pay our debts. We don't have anything of value within our organization that's worth as much as what we owe. So you definitely don't want a current ratio below 1. If your ratio is too high, then you are not effectively running the organization because you have a lot of idle funds. You have a lot of excess cash that's not being utilized. So that's why when we look at a current ratio, we're looking at 1.2 to 1.8 is considered balanced. And some will say, you can look for a ratio about 2. So let's take a look at what we have here. So we have for motor vehicles, we have 1.54, and let's calculate for our hotels. So when we find the current ratio, we are comparing, of course, our current assets to current liabilities. So let's go find current assets. Total current assets for the hotel industry are at 5,223.10 divided by our current liabilities, which are 249,956. So you can see that current ratio is quite low, sitting at 0.21. So the hotel industry has an issue in terms of not being able to pay their debts. So a concern for the welfare, and this is Canadian hotels that are small and medium-sized operations. The motor vehicles we see at 1.5, so balanced, and then you're going to find the restaurants and the non-store retail. You can calculate the current ratio for Amazon, for example, and how are they doing in terms of being able to pay that short-term debt. Now, the acid test is an amended version of the current ratio. So we take essentially the current ratio and we don't use all of the current assets, we take out inventory. And so this is a more conservative measure of whether or not the company can pay its short-term debts. So we're going to pull out the inventory part. Now, when we're looking at the acid test, we're looking for a number greater than 1. Retail and manufacturing who have lots of inventory are going to perform not as well on the acid test. And so it's important, of course, that we compare your company, like Amazon, to the industry that Amazon is in, that non-retail, non-store retail industry. So that you're really comparing apples and apples rather than comparing, as we're kind of doing here, the motor vehicle industry to, say, the hotel industry, because they have different amounts of inventory. And so we're using these general benchmarks of are they greater than 1, but really you should be comparing to your industry. All right, so the acid test, or called quick ratio, is current assets minus inventory divided by current liabilities. So let's take a look. When we look at the acid test for motor vehicles, we can see their number is a negative 3.4, right? So we want a number that's greater than 1. This is a bit problematic. And so we're coming back to the issue of COVID. And if we pull out of the assets all of the inventory, then we have an issue here for the motor vehicle industry. And as I said before, what happened during COVID is that they produced a bunch of vehicles, but it was all missing essentially one piece, one component. So they have a lot of money tied up in inventory that really just couldn't be completed. And so this creates an issue for the organization as we look at its ability to pay short-term debts if we pull out the inventory component. So a lot of vehicles produced, but the problem is that money is a bit tied up until those vehicles can be finished and sent off. All right, how does that compare to the hotel industry? So let's do our acid test for the hotel industry. Let's go, and we need to take our current assets. So we have that same 5223.1 minus, okay, and then we need to take out our inventory. All right, so give me just a second here. All right, so what we're going to have to do is we're going to have to calculate a measure for the inventory, because when we look at our balance sheet here, we have our closing inventory. So we're actually going to need to do a bit of a calculation. We need some open inventory plus closing inventory divided by 2 to do this calculation. And so you can actually see here for our motor vehicles, I have this calculation here at the bottom, where we are taking that opening inventory, closing inventory, and dividing it by 2. So let's see if we can find this information for the hotel industry. We have our closing inventory here. And we just need some of our opening inventory. So we can see on the income statement here, we have that opening inventory and closing inventory from the income statement. So we can go in here and we take our opening inventory of 74.4. Oops. And we have our closing inventory of 70. Stop clicking on random things. And we want an average of that. And I put that in the whole wrong column. So let's move that over to hotels. Okay. All right, so then we do our acid test. We are going to take our current 5223.1 minus that 72.2. That's going to be our current assets minus the inventory. And then we're going to divide by our current liabilities, which we got as 79.4290. And so we can see here that the hotel does a bit better in terms of that asset test. Again, it's a difference in inventory, right? How much inventory does a hotel industry have versus the motor vehicle industry? And that's going to change those numbers. So it's important to compare your Best Western to the hotel industry, your Ford dealership or Ford production to the motor vehicle one. In general, as we look at that acid test, we're looking for a number that's greater than 1. And in this particular case, we can see that neither industry performed well during 2021. All right. Let's look at our next one, which is receivables to working capital. So when we look at receivables to working capital, what we're looking at is our capital that's tied up. So we come back to the idea of accounts receivable. And so if we are looking at, and I'm just going to go back to our notes here. That's the income statement. Here's the balance sheet. Here's our accounts receivable. So accounts receivable, this is money that people owe us, right? Not to be, make sure we differentiate accounts receivable from accounts payable. Accounts payable is where we owe someone else. So it's a liability, it's our debt. We're looking here at accounts receivable. That's where our customers owe us. And so when we look at receivables to working capital, we're looking at how much of our capital is tied up. So if our receivables to working capital is high, we have more accounts receivable. So maybe there's a longer payment cycle, so people don't pay us quickly. It takes longer to get payments from our customers. Maybe we have more credit-based sales, and so we have to wait until they get paid as opposed to like paying in cash. So let's go back and let's look at how it works for the hotel industry and our motor vehicle industry. So when we look at our formula for our receivables to working capital, we need to calculate something called working capital. So working capital is going to be your current assets minus your current liabilities. So if you think about it, if we go back to, I'll just swing back again to our slides one more time and our balance sheet. So here are all our assets, right? We have our fixed assets like our machines and equipment, we have our inventory, we have our cash. If we take those assets and we subtract our liabilities, we subtract the debt, we're looking solely at the assets that have already been paid for. Okay, so maybe a portion of our equipment, portion of our inventory we still owe or we borrowed money to fund. The rest, the cash and the portion we've paid off, that is going to be your working capital, right? So that's what you have in terms of your operations on a daily basis in terms of producing. So let's go back. And what we want to do is look at receivables to working capital. So if our working capital is what we really have to kind of fund the operations with, to actually produce, the portion that's tied up, that's the accounts receivable, that's money we're waiting for, right? People who owe us. So that's not capital that we can really use on a day-to-day basis as we wait for that money to come in. So we look at receivables to working capital. When it comes to receivables to working capital, likely we want something that's going to be, less than maybe 0.5. The idea here is that we don't want too much of our working capital to be tied up. We don't want to have to wait a long time to get the money we need to pay for our daily operations. Now, again, if you have more credit-based sales, if you have a longer payment cycle, then that number is going to be higher. So let's take a look at the motor vehicles and to our hotels. So here you can see when it comes to motor vehicles, 0.25, and so a lower number, so less money that is tied up. when it comes to motor vehicles. And then let's find it for our hotel industry. Okay, so we need to go back to our hotels. And the first thing we need is our accounts receivable. So accounts receivable is coming from our balance sheet. So we see here 513.9. Okay, and now we need to look at working capital. So we need to calculate that working capital, and that's going to be the current assets. So that's the 52231 we had found before. And we're going to subtract from that our current liabilities, which was the 7942.90. Okay. And you can see here their receivables to working capital. Just double check that's right here. And so as we look at our number, what we see is that the current liabilities are more than the current assets. So the hotel industry owes more than they have in terms of value. And that's going to make that negative, that piece there. And then we look at receivables to working capital. The receivables to working capital is low. So less of it's tied up in terms of waiting for payment. But that negative there indicates another issue, which is the liabilities versus the assets. Just double check I didn't make an error there in that calculation. Total current assets, yeah. So you can see, right, they have a challenge in the hotel industry where they have more debt than they do in terms of the value they've created within the organization. Not a good time in the hotel industry in Canada in 2021. All right, we're going to stop this video here just for length. And then in the next video, what we'll do is continue working through that financial ratios. And then in another video after that, we'll start looking at benchmarking, where we use these numbers from industry, compare them to how our organization is doing, and use them to help make a plan for how we can improve our operations of our organization.